Hello, everyone. Today's Monday, August the 4th, and this is your 314 SMI update for the month. Fernando, how are you doing?
Doing okay. Let's get into this and start off with the FCT attribution report. How does that sound?
Sounds good. So anyone who's been following along, we do this every month. Quick 10-minute video, give you an overview of how the 314 SMI family of funds have performed. We start, as always, with FCTE. This is based off of the full cycle trend model that 314 Research created years ago. It's a quantitative model looking through the quality universe of the S&P 500, top 100 stocks based on quality, scanning that universe, and then looking for intermediate to long-term uptrends with short-term pullbacks. Equal weighted portfolio of 20 stocks. And so very concentrated bet, drilling down into quality. And as we're going to see here, a concentrated bet means that you can have periods of significant outperformance and underperformance. And our principle at 314 is either one. We're gonna be here. We're gonna face the music. We're gonna dig into it and understand what's driving performance. So, with that said, it was a rough month for FCTE. It was one of the worst months I can remember, honestly. Even just for the model that underlies the fund. What happened? S&P 500 had a pretty solid July, whereas the FCT was down a couple hundred basis points. You ended up giving up, I think, over 500 basis points of total relative performance. We were leading, this fund was leading the S&P 500 through the end of May, and that is a distant memory at this point in time. So what happened? The number one thing, just to keep it really simple, is that this has been a mega cap tech led market. The fund sold out of almost all of its mega cap tech exposure at the end of May and moved into kind of took a risk on this equal weighted non-tech quality strategy. So you have exposure to a factor that's been lagging. You have which is quality. You have underweighting cap, which has also been a big driver of performance in the market, and moving to an equal weighted basket. So those things, when you overlap those factors, it's pretty easy to see why we underperformed for the month. When you look at it, what drove from a sector perspective, that's what I like about these charts. You can see what drove the outperformance or underperformance. And again, had a tiny tech exposure, and that was in the green. But then having a big financials, which is mainly insurers and healthcare weight, that's what drug the performance down. For next month, the new picks, we have added back some tech in the form of Meta. So you have Meta and a couple of health providers. So Cardinal Health, Abbott Labs, also in there. This has been a rough period for healthcare. So interesting to see the models is drifting over that way, trying to catch some mean reversion. And we're selling out of some of the auto parts suppliers, O'Reilly and AutoZone. So it's an interesting mix. I think it's an interesting mix for going into the month of August. And to be honest, even though we're underweight mega cap tech still, even though we have some Meta in there, I think this is personally, I like this mix better than how I felt going into July. So we shall see how it turns out. Lots of stuff happening in this market under the surface, and just like we gave a lot of performance back last month, 20 stock concentrated portfolio can catch up really fast. So let's see what happens.
All
The
right.
other factor thing I wanted to mention about FCT is an old little story I had. I remember working with a quantitative fund manager at Wellington years ago. And they would talk to us about how flows into and out of funds would move with performance. And his point was, once you find a strong factor-based strategy, you should be allocating during months like this. I know it's hard behaviorally to do that, but if you believe in the research, if you believe in the underlying factor, because that's what happens. These factors go in and out of favor, especially in these kinds of rotational markets that we see. These are the times where you want to, I hate the phrase, but you got to lean into it a little bit. And it's just like buying a stock that's in a is a good stock that's pulling back. Ultimately, those are times to be allocating to it. So for whatever it's worth, if you're allocated to the fund, we're in there with you. And behaviorally, I think these are the times you want to look at allocating again, as much as that sounds rough to do.
All
Okay,
right,
so
moving on to the real asset allocation attribution report here.
yep, this is the same report for real asset allocation model. On the left-hand side, we look at the individual assets. On the right-hand side, we look at the asset class breakdown. Uh, One thing I'd say, real assets had a good string of performance here. It's been a very smooth and steady rise higher. I think we ended the month of July at or near, really within a penny of all-time highs for the fund. So that's good. Um, what was driving that performance? Well, big Nasdaq overweight was a factor there. So just like what the big tech taketh at FCT, it giveth on RAA, and so that's where you see the attribution report pointing towards Nasdaq being the big driver for the month for RAA. We also saw we say U.S. large cap, that's S&P 500, but the fund was underweight S&P 500, but still had pretty good exposure there. And then the other driver was Bitcoin, another solid month for Bitcoin. We are at a 3% max weight for Bitcoin within the real asset allocation model. I think that's one of the things that makes this strategy so unique is you have a big menu of assets, including crypto, including managed futures, commodities. We break commodities into energy and in metals separately because we have this belief that these commodities are not going to trade as a monolithic group. They're going to be on their own frequency as you have different drivers for each segment within the commodity segment market. So then you on the fixed income side, we have high yield corporate bonds, emerging market bonds, treasuries, all that stuff. And as the trends move, the fund moves around within all that those 20 different assets. So again, for the month, it was really Nasdaq and Bitcoin driving the outperformance. Fixed income lagged a little bit, but it wasn't too much of a drag on performance. I know a lot of people want to just totally jettison fixed income. I think that's a mistake, especially you see this jobs report last month at the very end on August 1st as we turn the calendar to August, and it's gonna. I think that downside demand destruction risk is going to reemerge, and that's where bonds start to buffer your portfolio. So there are no bad assets, only bad prices and bad scenarios. And so, in my mind, you don't want to be totally out of fixed income. You want to have it available and the ability to get into it if you see these kinds of trends emerge. So let's go ahead and see what we're doing for the month of August. So in August, the equity weight has gone up to 55%. Sticking with the Nasdaq overweight, you can see this table here where when it says July 31st, that's the weight through this August month, and then we'll rebalance again at the end of August. And so both of these models update on a monthly frequency, giving us a lot of opportunity to make moves, to harvest gains, things like that. So Nasdaq a big overweight, S&P 500 within equities is an underweight, and so that's where you're seeing that's the kind of give and take and how you're ending up with this equity overweight ultimately. Within alternatives, I think it's interesting that managed futures, it's still up below the benchmark weight of the model, but it's up significantly from last month. That's kind of an interesting little bit of when the model does that. You start thinking it's hedging something, or it's thinking about hedging something. That's the purpose of the managed futures there. Bitcoin remains at a max weight of 3%. Gold's at 5% overweight there. Commodities has gone from a big 7% weight down to 1%. So it took its gains there. The model did. Within fixed income, the model did dial some of its fixed income weight down. Most of the weight here for this month is in spread products, investment grade corporates, high yield bonds, emerging market bonds all have healthy weights. Long-term treasuries, not so much. So interesting kind of mix here. It's not the model is not scared of the volatility we've seen at the beginning of this month, and so it's still, I'd say, very modestly risk on and diversified, obviously, at the same time. So that is that's the real asset allocation model, how it's positioned for the month of August. Fernando, do you have anything to add to this?
No, I think this month was a great example, again, of this highly diversified set of assets and alternatives contributing to the return. I noticed a couple of days this month where the RAA was within spitting distance of the S&P 500, even though you're owning a portfolio that's, not 100% stocks, and that's all those other assets in there. having the opportunity to contribute to the return. And this month it certainly helped there, especially with Bitcoin. So that's what RA is all about.
Yeah, and the RIA fund is pretty new. It came out on February 26th, I believe. So at the old, really at the peak of the market earlier this year. And so the one good thing about that is that you get the chance to see how it performed in the drawdown through the Liberation Day tariffs. And the drawdown was, I think off the top of my head, just a little more than half of the S&P 500's total drawdown. So maybe a 10, 11% drawdown, whereas the S&P 500 was peak to trough down 18%. And that's what you'd expect. And then coming out of that rebound, of course, a little trailing a little bit, but still collecting, like you said, the vast majority of those returns in a very smooth equity line out of that drawdown. And so that's what you want to see. And again, we talked about this being a debasement world where the mindset shift amongst investors has gone from deflation, where you protect principal at all costs, to protect purchasing power and a debasement mindset. And in order to do that, I think you need to have diversification. You never know what asset's going to hit at what time. You need to have a system in order to continue to press in during those weak periods. Something that's totally diversified like the RA, I think really helps. So I think it's well fit for this debasement world that we're well into, but everybody's really waking up to at this point. So
Let's
okay.
wrap it up.
All right. As always, we have contact information on the site. We appreciate everyone out there. Until next month, have a good one.